Stop staring at the flashing red numbers on your screen. Stop letting television commentators soothe you with recycled talking points about stability and soft landings. And most of all, stop assuming that a falling price on a Western exchange means something has gone wrong. Because while attention is glued to charts in New York and London, a much quieter, far more consequential shift is unfolding thousands of miles away. It isn't loud. It doesn't come with sirens or emergency press conferences, but it carries more force than any interest rate decision or bailout package ever could. What you're watching right now is not a market correction. It's a distraction. The real move isn't happening on a trading floor. It's happening behind closed doors in Beijing, Shanghai, and vaults that don't publish daily inventory reports. The West believes it scored a victory by forcing prices lower, by proving that metals can be controlled. But in doing so, it may have just revealed its weakest flank. Because there's a difference between pushing numbers around on a screen and controlling physical reality. And reality is starting to assert itself. It's early February 2026, and the most important development of the day has nothing to do with where gold or silver settled. It has everything to do with a carefully worded article released through one of China's most influential policy journals. To an untrained eye, it looks like ideology. To anyone who understands how China communicates power, it reads like an order, not a suggestion. An order. These publications are not opinion columns. They are signaling devices. When something appears there, it is because the decision has already been made at the highest level. The message was simple, but devastating in its implications. China must strengthen its currency, expand its global reach, and secure itself financially against external pressure. This was not framed as an economic preference. It was framed as a matter of national security. Currency strength was explicitly linked to sovereignty, resilience, and long-term survival. That alone should make you sit up straight. Because nations do not talk this way unless they are preparing to act. For years, the global system has revolved around the assumption that the dollar is untouchable, that no matter how large the debt grows, no matter how aggressively money is created, confidence will hold. China has tolerated this system, even benefited from it, while quietly preparing alternatives. And now, for the first time, the language has shifted from patience to urgency, from observation to execution. The timing is not accidental. This signal came immediately after Western banks forced a sharp drop in precious metal prices. That move was meant to project strength, to reassert control, to remind markets who still runs the show. But to Beijing, it looked like something else entirely. It looked like stress. It looked like fear. And most importantly, it looked like opportunity. Because unlike paper markets, physical markets respond to incentives. And the incentive structure right now is screaming in one direction, east. For years, China's official gold holdings have been treated as a joke by Western analysts. Incremental additions reported here and there, numbers that never seem to line up with import data, mine output, or observable behavior. But those who track flows instead of press releases have known the truth for a long time. Gold has been moving into China at a scale that makes the official figures impossible. The metal didn't disappear. It didn't evaporate. It went somewhere. And it went into vaults that don't answer questions from the IMF. The accumulation has been methodical, patient, and deliberately opaque. Off-balance sheet entities, state-controlled financial vehicles, and military-linked storage facilities have all played a role. This wasn't hoarding for speculation. It was stockpiling for leverage. And now with the signal given, the market is beginning to understand why. Imagine the effect of a simple announcement. No missiles, no sanctions, no speeches at the UN, just a revised number. A statement that China's true gold reserves are not a few thousand tons, but many multiples of that. Enough to rival or exceed any other nation. Enough to fundamentally change how its currency is perceived. In that moment, confidence shifts, not gradually, instantly. The dollar's power has always rested on belief. Belief that it is stable, liquid, and backed by the full faith of an economy that cannot fail. But belief is fragile. And when confronted with a competing system anchored to tangible reserves, belief wavers. Prices don't adjust politely in that environment. They gap, they leap, they reprice to a new reality. This is why the recent price smash was not a victory. It was a gift. By forcing prices lower, Western institutions made physical metal cheaper at precisely the wrong moment. While retail investors panicked, large buyers stepped in. While commentators celebrated deflationary signals, cargo planes were being booked. The disconnect between paper and physical widened dramatically, and that gap is now acting like a siphon. To understand how dangerous this is, you need to look at where silver is actually trading when it changes hands for delivery. Not on a future screen, but inside China itself. The Shanghai market has been paying a significant premium for physical silver, far above Western spot prices. Even after taxes and logistics, the incentive is overwhelming. Buy in the West, ship east, sell at a substantial markup. Repeat. This isn't speculation, it's arbitrage. And arbitrage doesn't care about narratives, it doesn't care about politics, it follows math. When the spread is large enough, the flow becomes unstoppable. Every vault becomes a potential source. Every bar becomes mobile. And once that metal leaves Western custody, it does not come back. Shipping costs are trivial compared to the profit. Insurance, security, transport, all of it is noise when margins are this wide. For trading houses and banks, this is the easiest money they will ever make, and they are taking it, relentlessly, quietly, with no regard for the strategic implications. This is how empires lose resources, not through invasion, but through incentives. No one had to force silver out of London or New York. It walked out on its own, guided by price signals that policymakers themselves created. The very act meant to demonstrate control is accelerating the loss. Meanwhile, inside China, that metal is being absorbed. Not recycled back into markets, but consumed, used, locked into industrial supply chains, defense applications, energy infrastructure. Silver is not just a monetary metal anymore. It is a critical input for the technologies that define modern power. Whoever controls it controls production capacity. This reality has finally registered in Washington. And when it did, the tone changed fast. Suddenly, there are emergency meetings. Suddenly, officials are talking about critical minerals and supply chain resilience. Diplomatic language masks panic remarkably well, but the message is clear. The cupboards are being checked, and they don't look as full as expected. High-level summits are being organized with allies. The goal, officially, is cooperation. Unofficially, it is containment, an attempt to slow or block the outflow of strategic materials, to build a coordinated response that prevents China from absorbing the rest of the world's available supply. But this kind of response runs into a hard wall: economics. As long as the price differential exists, metal will move. If one road is blocked, another opens. If one country restricts exports, intermediaries step in. Black markets thrive where official channels close. You cannot decree gravity away. You cannot command water to flow uphill indefinitely. The only durable solution is price convergence. Western prices must rise to meet Eastern demand. Anything else is temporary theater, and the market knows it. That's why the recent smash failed so quickly. Prices didn't stay down, they snapped back. Buyers emerged immediately. The message was unmistakable. The floor is in. This kind of price action is revealing. When aggressive selling fails to produce follow-through, it signals exhaustion. The sellers fired their biggest shot and got nothing for it. The market absorbed it and moved on. That's not weakness, that's strength. Short positions that expected further declines are now trapped. As prices climb, they become forced buyers. Each uptick adds pressure. Each failed dip emboldens the other side. This is how squeezes form, not from hype, but from structural imbalance. And the imbalance here is physical. Paper claims far exceed available inventory. That has been true for years, but it only matters when someone asks for delivery. Now, more people are asking, and they are willing to pay up. While Western commentators debate macro theories, refineries are running nonstop. Old bars are being melted down, recast, and stamped for new owners. History is being erased and rewritten in metal. Once that process is complete, those bars are no longer compatible with Western settlement systems. They are removed from circulation, permanently. This is the silent part of the story that never makes headlines. The slow, steady migration of tangible wealth from one system to another. No drama, no countdown clock, just pallets moving through secure corridors, one shipment at a time. Banks facilitating this don't see themselves as villains. They see spreads, they see opportunity, and they are legally obligated to pursue profit. National strategy does not factor into a trader's bonus calculation. That disconnect is now being exploited at scale. When you see volatility on your screen, understand what it represents. It's not chaos, it's transfer. One side is liquidating, the other is consolidating. One side is trading promises, the other is collecting assets. Eventually, this process reaches a limit. Vaults can't go negative. When inventories are depleted, something breaks. Either prices explode higher to ration demand, or markets fail to deliver. Neither outcome is gentle. The recent rebound in prices suggests the first path is already underway. The market is doing what policy cannot. It is forcing recognition of scarcity. Each higher print tightens the noose around short positions and accelerates the feedback loop. And hovering over all of this is the unspoken expectation of an announcement. A moment when accumulated leverage is revealed, when numbers are updated, when confidence shifts from one axis to another. That is the essence of a financial parade. Not spectacle, but demonstration. When military hardware is rolled through a capital, it sends a message without firing a shot. Financial power works the same way. You don't need to attack the dollar directly. You just need to show that you don't need it anymore. That is the checkmate scenario taking shape. The board has been set slowly, deliberately. Each move forced a response. Each response weakened the defender. And now the options are limited. For those paying attention, the choice is not complicated. It's not about timing a top or bottom. It's about understanding flow. Where is value moving? Who is accumulating? Who is being forced to react? Paper volatility is noise. Physical movement is signal. And the signal is loud. The West attempted to project strength by suppressing prices. Instead, it revealed vulnerability. The East responded by absorbing supply. The market responded by refusing to stay down. And policymakers responded by calling emergency meetings. None of this is random. We are watching a transition, not an overnight collapse, but a shift in gravity. Systems don't fail all at once. They erode, then they tip. And tipping points are always obvious in hindsight. When the next announcement comes, it will feel sudden. Prices will move faster than explanations. Analysts will scramble to retrofit narratives. But the groundwork is being laid right now, in silence. So the question is not whether change is coming. It's whether you recognize it while there's still time to position accordingly. Because once the parade begins, spectators don't get to rearrange themselves. They just watch. The flow is eastward, the incentives are clear, the reactions are telling. And the game, whether acknowledged or not, is nearing its end. This isn't about fear, it's about awareness. Ignore the theatrics. Follow the metal. That's where the truth always ends up.